perspective, what we've done is actually we started rating investment managers on ESG. So we started in 2005, really mainly based on client demand. But from 2008, we sort of took a more holistic approach. So basically, the managers, Mercer monitoring, now actually all have a ESG rating. So I think in terms of maybe people might not be familiar with Mercer's database, we actually have a proprietary database called Global Investment Manager Database. We cover, I think, more than 12,000 investment products in that database. It's mainly for institutional investors, and from that database, more than 6,000 strategies are rated, and more than 5,000 strategies, investment products, actually are rated on ESG. So I think in terms of what I discussed, the investment supply chain, asset owners can either invest through asset managers, with their exposure to companies, or they can invest directly. So this is really, I think, in terms of the indices and ESG research, it's really, really saying, well, lift up the game, because everybody is doing it, and also the company level, you have more information available. So when we rate investment product, when we're talking to portfolio managers, we also asking them information in terms of, not just from their portfolio construction and how they actually pick the companies, but also in terms of what they do in the ESG space. And one of the questions we ask is, what kind of ESG research they have. Of course, if they say they use MSCI ESG research, or using Dow Jones, using your data, probably doesn't quite guarantee they have a brownie point, because we really want to understand whether they just buy the research and let it, stand on the shelf and getting dusted, or they actually really use it. We'd like to understand, but I think it's a good starting point. They're actually thinking about in the space, if they don't have resources internally to do it. Like, some of the fund might be well equipped, like the, Al Gore's, the former vice president of US, Mr. Al Gore, and I think he is a chairman for a fund called Generation, and their fund is actually truly integrated. So they really, all the analysts knows everything in this space, because it's in their blood of with investment research. But on the other hand, some other investment managers, if they just starting in the space, it's actually a very good idea to use third-party research. Depends on the region and also their interest and also the criteria. They're looking at materiality. They might pick different research provider, but it is really a good starting point. So it's just sort of linking to what you just said about in the space, the data will be useful, and the index will be useful as well, even if maybe people might not want to just invest directly into indices, because alpha is also important in this industry.
Right, and we all agree that sustainability investment is all important for all stakeholders, and we all know just a little bit about the the DJSI methodology. So can I ask the the MSCI methodology that you define the sustainability? Is it like
Sure.
the similar to the JSI, or is it different?
There's definitely areas of overlap. I mean, because I think the industry is becoming more mature, and definitions are becoming more and more clear. Maybe if we can flip back to my slide. You're doing a very good job of managing all of our many slide requests. Thank you. So, I mean, if we go back to just the one before, the world of potential environmental social governance risks is very broad. It is ill-defined. Sometimes when I speak to certain investors who say, "Oh, we do ESG. We have one person who has the sustainability hat." And I think to myself, well, we have a team of 150 people who think about this every day, and 90 researchers researching it. And I wish that I could tell you how difficult we find it trying to define what the issues are for companies and therefore for investors. But essentially, what we're doing, when you think about investors and why they care, all of these trends relate. They translate to certain risks and opportunities. Okay, so there's obvious. It depends on your investment strategy as an investor, what you're aiming to do. So if you're aiming to minimize volatility, you're maybe interested on the risk side. But I've spoken to a number of investors as well who are actually using the ESG research to actively trade around some of these themes, like water stress is very important for the Asian region. And there are opportunities that creates. Air pollution is a big issue in the region as well. That creates opportunities, trading opportunities as well. So alpha can be generated around these ideas as themes. When we have developed the various types of ESG research tools that assist with integration, we are trying to address, through our experience of dealing with investors at all different kind of points in the investment value chain, we are talking to them about what their needs are. So some of their needs are, we don't want to be involved with bad companies that have a bad reputation for whatever reason. It could be human rights issues, it could be environmental issues. So then that dictates the type of research or benchmarking that they need. Other investors, they want to be looking at forward-looking risks. So they're not so much concerned about bad performance or violation of global norms, but they're interested in future risk and future opportunity. So that's where an ESG rating provides a forward-looking signal of how that company's performance might be moving forward. And other investors, they're just interested in getting rid of certain industries from their portfolio, maybe for regulatory reasons, maybe for ethical reasons, and that's actually a whole area of research as well. So I think there's the point I'm trying to make is that there isn't just one way to integrate, and there isn't just one type of investor that's interested in this research. This can be integrated for all different types of investment strategies, active and passive. And so then when we think about an ESG index, the way that we construct it, we have different types of indexes as well to suit different types of investor purposes.
Right.
So we have, just to go through them quickly so that we can talk about definitions, we start with our Global Investable Market Index, which is what MSCI, this is our core business, is producing gold standard indices globally and also regionally. And then that gives us an opportunity set, and based on the use of our ESG research, we're then able to choose either the best in class to create a sustainability index, or we're able to screen out companies that are involved in certain controversial industries like weapons manufacturing or gaming or tobacco for a socially responsible style of index, or for a more an index that's trying to provide an opportunity set around a certain theme like the environment, we're also able to create an index that provides the opportunity set for companies that maybe have 50% involvement in certain renewable energy industries. So there's all different types of criteria that you can use in your index construction as well. MSCI has been, the oldest one on this list is the KLD 400. So that is actually an index that we inherited from a previous company that was acquired. And that index has demonstrated over a 23-year history of at least, as the other panelists have said, at least on par performance with normal or mainstream indices, and in certain market cycles or certain periods, outperformance. So the idea that you're somehow losing performance or you're giving away profit to be responsible is slowly becoming a myth that's no longer really validated by the data.
And as the procedures are, pretty much like so hard. I mean, it's tough to get into this MSCI, to pass the standard that MSCI, already set. How do you actually maintain or set up, the high standard in order to, to be the the criteria for the companies to get into the MSCI?
Well, there's two processes that I'm referring to on this slide. Essentially, the top level is the MSCI indices, and so if anyone's interested in just the kind of getting onto the criteria for being selected for a mainstream benchmark, that's something that if you come talk to me later and I can introduce you to my colleague Alers, who's here, who'll be able to fill you in. When it comes to the inclusion on the ESG indices, what we're using is our ratings research, our controversies research, our business involvement screening research, so research that tells us, is a company involved in weapons manufacturing, are they involved in tobacco? So we're using those factors to feed into our analysis of whether the company meets a certain base level standard. And then when it comes to construction, the companies need to have a certain minimum rating, a certain certain at least lack of involvement in bad controversies or bad track record to get onto the index. And then these indexes are reviewed periodically, quarterly, to see whether the performance has changed such that the company should stay on or be excluded. So right now, if we look at the top level, the dark blue at the top, the dark blue at the top. If we think about the MSCI Emerging Markets Index, this is an index tool it's a mainstream financial benchmarking tool. 95% of the capital that's currently invested in emerging markets is benchmarked to the MSCI Emerging Markets Index. On this index, which is large cap emerging market companies, there's nearly 30 Thai companies, for example. And then when we apply our ESG research layer, when we release the MSCI Emerging Markets ESG Index, which will be later in June, about 70% of the Thai companies on the Emerging Markets Index will automatically be included on the Emerging Markets ESG Index, which is actually quite a high rate of companies compared to some of the other countries we've seen in the region, like China and India, that have had much more kind of difficult and protracted problems in kind of dealing with ESG issues.
It seems to me that the DJSI and MSCI have a lot of procedures, to select the invited list, in order to be in the index. So could you please point it out, the different points that from, the MSCI? Because it seems to me that it's pretty similar, a lot of procedures and things like that.
I think it is very similar because we likewise look also at the large cap companies. But basically, maybe where we are different is that we obviously use S&P indices as they are our partner as a starting universe. So we also have a mainstream index. From that, we select the largest ones for emerging markets. That's the 800 largest emerging markets companies. And then from those, we only select the 10% best ones. For emerging markets, the difference to the other indices is that normally we compare them worldwide. But as the score distribution within emerging markets is so diverse, and if you think of it as a curve, it's quite flat but very broad, whereas a normal curve is a lot in the middle. We decided that would be the best and the fairest. Over time, we obviously hope that the markets will catch up and we can have more also in the world index, and also just use a slightly more strict selection rule. But basically, you have to be amongst the 800 largest companies in terms of market cap, the float-adjusted market cap, I should say. And then you're eligible. We do a yearly assessment that runs from April through to June. So there may still be some companies submitting their answers this week and next. And then we start looking through the answers, checking them, doing our analysis, and then we announce the results each year in September. Obviously, as I said before, some of the ongoing checks, particularly around controversies, that happens throughout the year, and we have some periodic adjustments likewise. So I think that's all very, so it's relatively similar.
And in the response of the rising demand of the asset managers and also asset owners of the sustainability investment, so do you have any services offered to the clients to achieve their expected returns or achievement their goals?
So you mean for companies
Right.
to make it into the index?
Yes.
No, we cannot. As we are an index provider, we cannot. We set the rules for inclusion. Then we cannot also go and say, well, this is what you need to answer in order to get in. Yeah, so it's a governance issue. But what we do, as I said before, we have the ability for non-listed companies or non-eligible companies to ask for an assessment. Our normal assessment is free of charge, but if you are not eligible, then we do charge a fee. So that is one of the things that's available. There are obviously lots of local consultants who are very happy that we don't provide the service. So they make money off the various indices and the companies wanting to get in. But the other thing that I want to say is that all fun put aside, obviously it's important that we engage with the companies, and some of the criteria are obviously also determined with the specific industry, because those companies also know best what the challenges are that they face. We have very respectable analysts who know their sectors well, but if we start asking questions that's so far out, then it doesn't make sense to ask those questions at all. So then we better ask questions that the companies feel more comfortable with. So what you see in terms of the development of the questionnaire, we do change it, but we never change the questionnaire 100%, because one, the investors wouldn't like it, there would be so much turnover. Two, the companies wouldn't like it because you can then not measure progress. So we try to change, and if we see questions, I gave the example before on the corporate governance, on the philanthropy, if the answers are really converging, then it doesn't make sense to ask that question anymore. Either we remove the question, or we put in more detailed, more specific questions to still be able to distinguish. So if a company really wants to get into the index, I said the invitation comes automatically. We send out first message in about March, mid-March. The official invitation follows usually early April. And then I said, then there's 2 months to respond. Again, there may be reasons, very valid reasons, that a company cannot respond within those 2 months. I mean, we have some companies who report their last year's figures just at the end of that period. So if they, just around end of May, publish their results for 2012, then obviously we'd rather use the 2012 data than the 2011 data. So then it is possible to request an extension of the deadline, but no further than, I would say, about mid to late June. So that's
what about in terms of the investors? Like if they have specific the expected return, do you have any suggestion or recommendation of how to use the DJSI in order to meet their objectives?
It depends on really, you got it right. It depends what their objectives are. So if for some of them who are active investors, they may just use our index as a universe to pick from, and they may apply additional screens or additional analytics to then pick their own, or overweight or underweight, or do whatever they like. So that is definitely for those who are looking for additional outperformance, that may be a good route to go. Otherwise, we do see that the indices tend to appeal particularly to the more passive investors who are happy to have a market-conform performance. So I'm not, and I speak to lots of financial institutions on a daily basis, I'm not convincing people that it's all about the outperformance, but I think, coming back to one of the questions you asked earlier, if you have the choice between investing in companies whilst taking this into account and not doing so with the same results, which one would you go for? And then many people tend to say, okay, then I'd rather take the ESG issues into account and therefore have a better informed decision.
Right. Let me ask the Xinting about the investors' perspective I mean, like, the investing process, they have to analyze a lot of things. How they use, the specific index, because there are a lot of indexes right now that, that try to judge or, try to give the score to the companies that are, comply with the ESG index and things like that. So which one should we follow? Because these two, of course, are reliable, but there are a lot of other, rating experts out there in the market. So, which factors that, investors should look at before choose anyone?
Yeah, I think maybe if I could go one step back, really, what's driven in the investment in this space is the UNPRI. We look at investors. If we could arbitrarily, put it into global investors that are interested in investing into Asia, or the local investors, which mainly I think, especially with the sovereign funds, they with their local market, obviously with the home base, they'll have a large allocation to the local market. They also, so these two categories, they really, especially the responsible investors among these two categories, they are sort of driving the investment in this space. In terms of the the global investors, when they're looking at this region, I think one thing is either there's two things they can choose from. Once they can do index investing, or they can decide on whether they go with a specific product, which has actually fully integrated environmental and social governance issues into the process. Our advice to our clients is, of course, we'll start from asset allocation. It's really it has to sort of work with the strategic asset allocation, and also has to fit with the risk appetite, because I think if we look at all the indices, and the other active products, the major differences is with indices, apparently it's comparably low cost, so the fees is much lower, but the probably expected return, overall on average, it's probably lower than if you go with an alpha product. So to our clients, we advise them in terms of, if they're happy with their asset allocation, we can help them to select whether it's an alpha product or it's indices. And also with indices, apparently, well, the methodology sounds sort of similar from the surface, but I'm sure, if you really look at, granularity, there are still differences among different indices. So I think what we're doing, we like to understand what our clients really want in the space, and trying to provide them with especially on the portfolio approach, starting from asset allocation, how much they should allocate to indices, how much allocate to alpha product, and also in terms of each one, which actually product they should choose from. So that's our sort of general approach in this space.
Wait, would you like to add anything?
I think just a couple of points. What Kathleen mentioned about the importance of independence. I think it's important, if you're evaluating an index provider or a benchmark, to have a few principles in mind. So, one thing is stability, expertise, and the ability to maintain the index over time. Another very important aspect is independence. So, is the provider, consulting to the companies and telling the companies what they should be doing to, maximize the corporate strategy, as well as rating them? There's an inherent conflict there. So these types of issues, and then that's just for any mainstream type of index. But then when it comes to ESG research, think about, I suppose one quality that we find is very appealing to investors is the focus on materiality. So you need to understand the underlying research, not just look at the list of companies on the index, but understand the process of how those companies got onto that index, as you were asking before, and then what is their methodology for moving them on and off. So when we're doing ESG research, we focus on the material ESG issues, the issues that we would look at for Siam Commercial Bank, for example, is going to be issues around financial product safety and innovation around access to finance, and the environmental impact of lending, which is very, very different to rating and analysing a company like Indorama Ventures, which is a chemicals manufacturer, particularly PET plastics. So Indorama is going to be much more exposed to carbon emissions, toxic emissions, and so by having a very narrow focus, not narrow, but a very defined focus, but a deep focus on the material issues, what we're doing then is creating that comparability across industries and across companies, and ultimately across regions. So I think understanding the research underlying the index is also important for an investor.
Right. For anyone would have any questions, please raise your hands, and our good-looking staff will collect the papers, and we will ask the speakers. Right? We have about like 15 minutes left, so we will talk about Thailand's context. Do you think that any countries or any emerging countries could be a good model in order to develop the sustainability investment that we could follow, both in terms of index and also the companies?
Yeah, we recently published a paper looking at the emerging markets, not necessarily from an index perspective, but just in general. And I think on the one hand, for investors, there is still traditional methods don't always work when you apply them to emerging markets companies. So people are looking for alternative ways of being able to determine value. On top of that, I said it before, it's a very dynamic space, and we can see a lot of progress in short periods of time. And furthermore, companies that are operating in emerging markets really have all the challenges, Emily already said it before, all the challenges that everybody is dealing with, they've got here on a plate. I mean, if you are operating in this region, you have to deal with water issues, you have to deal with social and labor issues, you have to deal with a variety of ESG issues, and I think this is probably one of the spaces where those ESG issues are most visible if you compare it to other more developed markets.
I could just quickly add to that. I think, it's sort of linking back to what we just discussed before about in terms of the single country coverage, because when you look at the indices, MSCI indices or Dow Jones Sustainability, it's really, the reason I think it's sort of single country coverage is not as great as maybe the local investor wanted. It's because historically, when global investors looking at the region, their product, it's either global emerging market or, Asia or Asia ex-Japan. So in that sense, it's really, it's going with the trend. But, I think with the development of sustainable index, hopefully it will help to a lot of the global responsible investor to come into the region thinking, well, they can, not just investing in a more broader market, but also can actually have more allocation to a single country. It might take a while, but this is a good starting point as well, I think.
Right. And we got some questions from the floor. And what would you like to add anything first? I see you move.
I think there's many ways to get there. I don't think there's one perfect role model that Thailand needs to follow, but I'm very encouraged by the very genuine sentiment I feel here of among the institutions working in partnership with companies, working together with investors to bring this into the mainstream generally. And I think there's many other stock exchanges, there's many other dedicated sustainability investors to learn from globally, both in emerging markets and in developed markets.
Right. Let's move to the questions and answers sessions because we are running out of time. On your graph showing gap between corporate investors' ESG integration gap, did you mean to say that at present the investors are lagging behind the corporate and do not take into consideration when deciding where to invest their money?
That is exactly what I meant. On average, I said before, there are some exceptions either way. So there are some companies that are lagging behind. There are also some investors that are way more advanced than the average investor. But yes, the